Welcome to Factoring 101. I'm Dave Coker-Hook with Midland American Capital. So here's a question. When does it really make sense for a business to use factoring? I believe there are three specific times in a business life cycle when it can be extremely helpful. 1, when a company is starting up. 2, times of rapid growth. And 3, during a recession. In this brief video, we're going to take a look at all three. First, startup companies. A startup company cannot qualify for a business banking loan because they have no history. Typically, a bank looks for 3 years of business history before it will lend to a new company. But a factoring company is not worried about the length of time you've been in business. If you have a product and/or a service that can be delivered and invoiced, you have valid accounts receivable. And that's what we look for. As long as you're selling to companies with good commercial credit, we can move forward, regardless of the age of your business. So now the second time when a company has a good chance to use factoring is during a rapid growth spurt. Rapid growth means you've closed lots of business. But that also means your expenses to deliver on those sales go up. Chances are your customers will have payment terms somewhere between net 30 and net 60 days. And consequently, your revenue will lag behind your expenses. That's a significant cash flow challenge, and your books, your profit and loss statement, will not necessarily look good. In most cases, a bank will want to wait and see if you can sustain that growth and handle the new volume before lending. A factoring company, on the other hand, sees your sudden growth as a sign that you're doing something right. You can factor some or all of these invoices to access the cash you need to handle the increase in material costs, equipment costs, and/or payroll costs. In other words, we've got your back. And then, when you reach a new normal, you can go back to the bank and get a regular commercial loan. Now, the third time when it makes sense is when there is an economic constriction, like the 2009 global recession. Now, recessions are nothing new, and in any recession, banks are less able to lend. But the 2009 recession was extremely deep, and the effects will last for several more years. And at the worst of it, most, if not all, banks virtually stopped new lending. They terminated existing lines of credit, and they called in loans. They had to. They really didn't have much choice. But in such times, businesses still need a way to manage cash flow. Now here again, factoring can be an ideal solution. We leverage outstanding accounts receivable to provide the cash you need for day-to-day operations. Now look, your company's credit may have been damaged by the recession such that you couldn't qualify for a bank loan now, even though some funds are available. But that's okay, because factoring can be the solution to rebuilding your credit rating and becoming bankable again. Now the point of all this is that there are multiple financial tools available to you. But there are times when certain tools are simply not accessible. And when that happens, use a tool that is accessible. Use factoring.